Two. Hello and welcome to the Spark Accounting Solutions Facebook Live show. My name is Jennifer Quinn and I'm with Julie Babcock-Hyde. She is the founder and CEO of Spark Accounting Solutions. She's also a CPA, CFM, Profit First Professional, QuickBooks Pro Advisor. The list goes on and on. Hello, Julie. How are you today?
Good. How are you doing?
I'm doing well. I'm excited about this topic because who doesn't need to know the mistakes that they're making? Like, how many people don't even know the mistakes that they're making, and so they don't even know to correct them?
These are common mistakes. A lot of people make them. And so if we can avoid them, hey, that's great. And with it being the beginning of a new year, people probably have some big goals. And so if we can help them avoid a few little mistakes to get them to their financial goals, let's do it today.
Let's totally do it. Before we jump in, I want to say hello to the viewers. Whether you're watching live or later, go ahead and leave your comments and questions, and we will get to them. If we can't get to them live, we will definitely come back in and answer those questions. And so welcome. And Julie, let's jump in to the first mistake that's very common that we definitely want to avoid.
Yes. The very first one is not having a revenue and spending plan.
Okay.
And then I'm going to continue on with that, which is if you do have one, not tracking your progress against it. And so
okay.
Yeah, let's talk a little bit why it's important. Number one, let's talk about weight loss for a second. And I'm going to tell you why we're going to talk about weight loss. What is the number one thing that almost every program has you do in regards to what is going into your mouth?
Tracking it.
Absolutely tracking it. Yeah. And why do we track the food we eat when we're trying to lose weight?
Well, if you don't know what you're inputting, is that even a word, inputting? If you don't know what you're ingesting, then you don't know why you're getting the results you're getting.
Exactly. And so, so tracking where we're at with our spending and with our revenue is important. And before we start tracking, we need to know what our goals are as well. And that's where having a plan comes into play. And a lot of people will push back on developing a plan, and they'll say, you know what, things change all the time. It's never going to be right. And the fact of the matter is that you're 100% correct. None of us are psychic. None of us are going to have an accurate plan. If you do have an accurate plan, please call me with the lottery numbers for the next lotto drawing too, because you have to be psychic if you're going to get that right. Most of us don't. But what developing that plan really does is help us know where we need to focus for the year. If our focus needs to be sales growth, that drives our spending decisions. If our focus is, I've talked to people before that said, I don't want to add any new clients this year. I just want to operate more efficiently. So what does that tell you about where their advertising spend should be?
Oh, that is so huge. It's so huge. If you don't want to grow your client base or your customer base, then you're right. Why are you putting money into marketing?
Right. And so it's really important to know like what that goal is. And a lot of people do those kind of, what's your word for 2019? And that's great. But you can also kind of have that word or that plan for what your focus needs to be for your business. And if you don't sit down and think about that, it's really easy to get sucked into, oh my gosh, there's this new cool conference over here that I want to go to, or, oh my gosh, there's a new subscription that I want to add that's going to, change the world for my business. But if those aren't going to support your ultimate goal, you want to avoid them. But so have that plan and then track how you're doing against it so that if you're getting off course, you can make a course correction early in the year and not at the end of the year, all of a sudden go, what happened last year? I wanted to take home $50,000 more and I have actually contributed another $20,000 to my business. Something's broken here. So track, make a plan and track how you're doing against it and know that your plans will probably change during the year and that's okay. But remember what that original plan was. Remember what your focus was and make sure you're staying on target with that.
That's really good. One of the analogies that I like to use for that too is if you're going on a road trip and you just take off in your car and you don't have a destination in mind, who knows where you're going to end up?
Exactly.
Yeah.
And if you don't look at that map every now and again to see where you're at, you may still end up in the wrong place.
Or if you turn off GPS.
Exactly. Make a plan and track and make sure you're headed the right way.
Very good. Love it. Okay. Good. Number 2. Now this one I find fascinating. And we all, do this in one form or another. And it's not getting rid of bad inventory. So talk to us a little bit about that one and how that looks with different types of businesses.
Right. So this one is mainly focused on businesses that are like wholesale or retail that are selling products.
Okay.
It is not unusual. We all see it at the end of the season. There's a clearance, right? There's a clearance sale at the store because some stuff just didn't sell. The colors weren't right. If you're, if it's clothing, the colors, the style just weren't quite right. If it's, other, I'm trying to think of other examples, but it feels like it's Monday and it's not. So, but there's always stuff that doesn't sell. Just because nobody ever buys stuff thinking, well, I'm not sure if this is going to sell or not. Let's just throw it on the shelves and see what happens. Most people buy stuff that they really believe is going to sell.
Sure.
But the problem with that is you've taken money now. If you're worried about cash flow, you've taken money and you've tied it up, and it's tied up in something that may or may not be selling. If it's not selling and you get to the end of the season and it still hasn't sold, there are businesses that continue to hold on to that.
Really?
Yes. And so they keep having all that money locked up in inventory that they can't sell. They didn't sell it this year. What's the probability that they're going to sell it next year? It goes down even lower. And so we'll see businesses sometimes that if you look in their stock room, they'll have inventory that's got 5 years worth of dust on it.
Wow.
And that's cash that's locked up. And the other important thing to know about that money that you've got locked into inventory is that generally speaking, you can't take a tax deduction for that until you have sold it.
Okay.
So you've shelled out money, you're not getting any tax benefit from it, and it's just sitting there. So it's really important to do a look around and say, what's not selling? One, it gives you the opportunity to liquidate that so that you can get cash back in the business. And 2, it gives you an education about what your customers are buying or not buying, or whether your marketing for that product is working or not. So it's important to really look at that bad inventory and get it out the door and learn the lessons from it so that you can keep moving forward.
Excellent. I love it. I have a question for you on that.
Yeah.
Is it beneficial to donate the bad inventory, and will you get a tax break that way?
Yeah. So generally the rule for when you donate inventory is that, we're all used to taking the fair market value of the stuff that we donate personally, right? But for businesses, it's a little bit different because it's the lower of cost or fair market value. The lower.
Okay.
So usually if you spent $50 on an item that you think you're going to sell for $100, but you donate it, you're going to get that $50. Unless you've held on to it for 10 years and the fair market value is no longer 100, the fair market value is now 25.
Ooh,
and now you're only going to get 25 for it, which is another good reason not to hold on to bad inventory. Because you don't want that fair value to drop if you are going to donate it. So that's a good question. It's a great question.
Ooh, yeah. Okay. Good reason to go through your stock room at least once a year, if not more often, right?
Yep. And look for dust.
I like it. Look for the clues. Dust being the number one. Yep. Okay, perfect.
Yep, absolutely.
All right. And so number 3, not planning for big ticket items in advance. We were just talking about this before we went live, that I feel like it's time for me to upgrade some of my equipment in my office. And so talk to us, of course, me, I want to hear about me. How do we plan for it in advance?
Exactly. There are like several big categories of expenditures that a lot of us have. For a lot of people, it's employee and staff costs. For some people, it's like production equipment. It can be, high-end computers and video editing software. But when you look at those things, you're usually shelling out quite a bit of money.
Mm-hmm.
And none of those things are easy to get your money back on, right?
Right.
If you go out and buy a high-end computer and high-end video editing software, you're probably going to turn it on. You're probably going to start working on it, and nobody's going to let you return it and be like, I can't afford this now. Let me return this. Same thing with the equipment. If you go buy a big piece of manufacturing equipment, you can't just take it back. You're going to have to resell it. You're going to have to make some big choices around that. If you hire an employee and then you decide you can't afford them anymore, I think this is probably a nightmare for most small business owners. Nobody likes to let people go.
Mm-hmm.
Ever. And so finding a way to avoid that is a great idea. And so really thinking about how much revenue you need to generate to fund that is important. And then making a plan and starting to save for it in advance so you don't have to finance all of it. So you don't have to take out a working capital loan so that you can pay your person. What we generally recommend for our clients is to actually open a savings account and act as if for at least 3 months. And what I mean by acting as if is, let's say you decide that it's time to get into a bigger rental office, and your rent's going to go from $600 a month to $1,200 a month. Our recommendation is that you start putting that additional $600 a month away. You're going to know quickly if you can afford it or not. And then when you're ready to make the commitment, you've got a little bit of money set aside for deposit. You've got a little bit of money set aside for the moving truck, or you've got a little bit of cushion those first few months if something big changes. So acting as if really helps you kind of analyze whether you're ready for it or not. One of the things you may find as you're acting as if, that back to that rent example, if you're going from 600 to 1,200, maybe you find out the first few months you can only afford to put aside an extra 200.
Right.
And you're out of money. You've got a clear message that you're not ready to do 1,200, and you can make some changes ahead of time so that you're not in a financial crisis once you've made that commitment.
Yeah, just hearing you describe that, I can just feel the stress level going down in operating a business, because there's no like crisis moment of, oh, how am I going to pay my new employee or pay the rent or whatever.
Yeah, and I really love this for new employees because let's be honest, the first month or two when you hire a new employee, they're not the most productive employee. You're still training them. They're still figuring out how everything works. They're still learning about your business. They're still learning about your customers. And so it's important to really have that cushion, I think, especially those first 3 months. Well, they're still learning and you're still training them and they're getting up to full efficiency. So I really love it for all of those, whether it's rent, whether it's a big purchase, just finding a way to make sure that you can afford it and giving yourself that cushion once you've made the change so that if something unusual does happen, let's say you lose a big customer or you have some unusual expense come up that you weren't planning for, it's not going to create a crisis.
Right. And it's never a wrong or bad idea to have a cushion, ever.
No, never.
Okay, perfect. So number 4 is kind of similar, and I'm interested to hear how it's alike and how it's different, and that's not planning ahead for the financial needs of growth.
Okay. This one for me really specifically relates to when your business is growing so fast that you might need financing.
Okay.
Let's go back to that retail company that we were talking about earlier.
Right.
So they've bought product that they need to sell. They're not going to put that on their shelf and have it immediately sell. Right?
Right.
And so they have to wait for that cash to come in. If they're a wholesaler, they may be selling, net 30 and waiting 30 days to get paid, net 60 and waiting to get paid 60 days, depending on who they're selling to. So they've got cash going out the door, let's say January 1st, they buy some stuff. They got cash going out the door. They don't start getting paid for that until February 1st, March 1st even. Well, if they've sold that stuff in January, they need to restock inventory.
Mm-hmm.
How are they going to do that if they don't get paid until March and they've got a huge growth curve right now? Because they're not just replacing this much inventory. They're now expecting that they're going to sell this much inventory. And then they're going to sell. And so there's a constant cash shortage. And so they need financing. Let's go back to our personal lives for a second. How easy is it to get financing when you really, really need money?
When you really, really need it, it's not super easy.
It's not the same for businesses. It's really good to have a plan in place ahead of time, right? So these are our cash projections. This is what we're going to need for cash flow. Because if a bank comes in and evaluates your financials, and you've got a huge accounts payable and a little accounts receivable, or a very small cash balance and a whole lot of liabilities, they're not going to want a loan to you. And so having that plan, and working with them ahead of time to identify what your potential needs are while your financial situation still looks strong. Even though you're growing, they do look at, where things are at, and they want to know that they're going to get repaid. And so the stronger your business is, the earlier you can make a plan for that money, the better. And the other comment I want to make about this is that a lot of small business owners have a very hard time getting funding through their bank. A lot of banks don't like to loan to small businesses. They're riskier. And there's a whole lot of options out there. There's, we probably have all seen ads for Cabbage. Intuit has actually started Intuit Capital, and they're starting to loan money to small businesses. Fundera is out there. Fundbox is out there. There's all kinds of options out there for borrowing. But there's also options that aren't necessarily that favorable to the small business. And so understanding, again, what it's going to cost you to borrow is important, because that can help you factor in your pricing, so that if you have to do more expensive borrowing, you can make enough money to pay for it. But really looking at those options sooner rather than later. There's a lot of people that, are processing payroll Friday night at midnight and look down and go, oh, I don't have enough money to do that, and are trying to get financing that night. And those are the people that often end up in the worst small business loans.
Sure. So, that makes sense. So I was just going to ask you, in your experience, what percentage of small business owners are operating so close to the line that they do find themselves in the crisis mode of, I need money?
It's not unusual at all. Typically, based on some different studies, you're going to see 2/3 to 4/5 of small businesses are operating paycheck to paycheck, or a break even or worse.
Sure.
Which means if something pops up, something unusual pops up, they could be out of cash right then, and they have to do some unplanned borrowing.
So that's good to know for anyone who's watching this who feels like, oh no, this is me. Well, if it's you, you're not alone. And these are some, ways to maybe not be that person in the future.
Exactly. And, this goes back to number one, which was having a plan. But a lot of people, when they develop a plan, just look at the income statement. Then they don't look at their cash flow needs. And so this is taking it down even further, and really looking at when you expect your cash to come in and go out, so that if you do have borrowing needs, you can identify it early before you're taking money from whoever will give it to you.
Right. At whatever percentage rate they determine.
Exactly.
Right. Okay, good. I love it. Now, number 5 is also interesting to me. And it's another common mistake that a person can avoid is not planning for profit. And when I read this, I was like, but isn't that why we're all in business? And yet maybe not necessarily.
Yeah. Let's go back to that same statistic. 2/3 to 4/5 of businesses are break even or worse. So even though we all have the best of intentions with our small business, we often tend to spend all of the money we have available to us. And as a
I see.
and as a profit first professional, I can't not talk about profit. And so
Right.
what we've found with this whole idea of planning for profit is that if you don't actually focus on profitability, it often doesn't happen. So many of us are focused on our sales figures that we grow our business regardless of whether it's making us more money or not. And that's just crazy, right? I'm going to double my sales and my profitability is going to decrease. It happens all the time. And if we're not focused on both, if we're only focused on our top line sales and not our bottom line profitability, we can end up in trouble. And so as a profit first professional, we always love to recommend planning for your profit first. We're going to reverse engineer what's available to you to spend as expenses by automatically setting aside a portion of your sales for profit.
Okay.
So the reason this works is because most human beings have a tendency to spend all the money that is available to us.
Isn't that true? And isn't that crazy? Like, it doesn't matter how much your income goes up. You're just spend. I mean, I am, and I know a lot of people that just spend.
Yeah,
crazy.
It absolutely happens all the time. So, whether that is, it happens with our time, it happens with our money, It happens with our salaries. But let's take an example from our personal lives that I always like to use, and I'm going to use it again. Let's say you have a 401k plan and you increase your contribution to your 401k plan by 1%.
Okay,
your household income has gone down a little bit, but somehow, despite that 1% being gone from your paycheck, you're still able to pay the mortgage or rent. You're still able to feed everybody. You're still able to take your summer vacation. It's not ruining anything. You make a whole bunch of small little adjustments automatically just because that money is no longer available to you. And
makes sense.
Your business can do the same thing. So if you are not currently planning for profit, my challenge to you would be to set up a bank account that you don't have easy visibility to and you don't have easy access to, and start with just 1% and plan for profit and set that 1% aside and see what happens this year. See how much money you've got in it at the end of the year or at the end of the
That's a good challenge.
Yeah.
I like that a lot. So is it just an automatic every time you have a deposit?
So we typically recommend transferring a couple times a month. Some people will do it with every deposit. Some people will start out and say, you know what, I'm scared to do 1%. And so I would say, okay, I'll challenge you to do $5, $10, $100, just something to start getting in that mindset that I'm going to plan for profit and I'm not going to spend every dollar that my business brings in.
I love it. Tell me a little bit about what Profit First is, because I know that you're offering the 5 core chapters of the Profit First book. Say that 10 times fast. You're offering that, but what is the basic concept of Profit First?
Absolutely. So Profit First is a cash management system where we basically focus on paying yourself first.
Okay.
We focus on paying the business first via profit. We focus on paying the owner first via owner's pay. We focus on making sure we've got enough money to pay taxes because those happen when you're running a profitable business. And then we operate the business on what's left over. We spend expenses based on what cash flow is left over. And so it's really just a way of managing your cash flow. With Profit First, we use at least 5 bank accounts. Money comes into one, and then it goes out into those other 4 accounts that I mentioned: profit, owner's pay, tax, and expenses, a little bit into each one so that you know what you're supposed to be spending your money on. Right now, if you only have one bank account and you look at your bank account, you have to do a whole bunch of mental math, right? And say, okay, my tax bill is going to be $10,000 at the end of the year, and it's June, so I should have $5,000 in there, so I can't spend that money. and I want to have some profit, and I've got this big piece of equipment that I'm saving up for, and you have to do a whole bunch of mental math. The beautiful thing about Profit First is we have these bank accounts that are for specific reasons, so that you can look and say, this money right here is my tax money, and I've got it set aside, and I'm not going to spend it. This is my operating expense money. This is what's available to me this month to meet my operating expenses. So that you can look at, much easier visibility and much easier way to see what your cash has been designated for.
Again, when I hear you describe that, I just feel like stress going down.
Yeah, it's a lot of people, when they first hear about it, are scared because of the multiple bank accounts. But once they get into it and they can actually see, hey, this is my profit. That's the money that my business made this year. This is my owner's pay. This is what's available to me to pay myself. A lot of those small businesses that are, the 67 to 80% are not paying their owners enough money. And knowing that they've got funds available to pay themselves is incredibly stress reducing. And again, knowing they've got money to take care of tax man. It's tax season. People are starting to get stressed if they don't have anything saved about where that money is going to come from. And so knowing and looking at a bank account and saying, oh, I've got that covered is a very freeing feeling. So yeah, it is really stress reducing.
Awesome. Awesome. Good information. Krista Sutton said, Profit First is amazing. Thanks so much for sharing. So very, very cool. And I just got distracted from a little technical thing, so I apologize for that. But Julie, so as we are heading out, what is the first action? Well, you already said open an account and put 1% in.
Yeah.
Do you have anything else to add?
I think number one, start planning for profit. I'm always going to stress that because I want to make sure we're all working really hard as small business owners. And if we're not making a profit, it's really frustrating and discouraging. So that's going to be my very first challenge to you. But number two is really look at that revenue and spending plan for 2019. Make sure you have thought through that. Make sure you know what your focus is for this year. If your focus is growth, plan for growth. If your focus is getting your systems in line, plan for that and adjust your spending accordingly based on where you need to grow. And going back to that whole concept of growth, if you're just focused on sales growth and you're not focused on profitability growth, you're still not spending your money in the right place. So make sure you've got profits and make sure you're focused on both sales growth and profitability growth so that all your hard work actually ends up in your pocket.
So good. So good. Julie, thank you so much for your time today. Thank you to all the viewers watching. And again, if you have questions that we didn't cover, go ahead and leave them in the comments or click send a message on the Spark Accounting page and someone will get back with you.
Yeah, absolutely. Thanks everybody for coming, and feel free to grab the core chapters of that Profit First book. It'll introduce you all the basic concepts.
Awesome. Perfect. All right. Thanks so much. Bye-bye.